Good evening. It is time for today's tax talk. I'm your host. I'm attorney Stephen Leahy, and today we're going to talk about the IRS. I think they found another boogeyman. I've been talking about the three boogeymen. They might have four. I think that's what they're going to do. They're going to have four boogeymen now, and that's going to include your business. So if you're having some trouble, let's talk about that. We're also going to talk a little bit about the problems that the IRS is having processing returns and other great things that we'll talk about. So let's start the show. Uh-oh. Yeah, production value could be better. I'll give you that. I'm working on it. But this is what goes on. I want to thank you so much for joining us here on the today's tax talk, and I want to I've been talking a lot about the three boogeymen that I think the IRS is using. They're gonna the new bill's going through. It's going to raise everybody's taxes. They're going to do that later this year also. They're very hesitant, they being our politicians, are very hesitant to do that right away. They want to say that they have turned over every stone in order to avoid it. When they tell you that these new spending programs are paid for, what they're telling you is first they're going to raise your taxes. And capital gains rates are going up. We all know that. And they may go up to the point where capital gains, it's just like income. So more and more people will defer their capital gains, and they won't sell these assets and put them back to better use just because of the tax implications. And I don't believe that helps anybody. It does not help our society, and does not help the tax man, because you won't get more taxes because people won't sell. So there's always a reply whenever the IRS takes action to gather more money. People make rational decisions and avoid the tax. So the three that I've always talked about, the wealthy, the millionaires and the billionaires, right, that they're going after them. The tax gap. And this is kind of in the tax gap, what we're going to talk about today, the S corporations, that the IRS is targeting S corporations. S corporations are what they call pass-through, and you'll hear a lot about this. Hey, these pass-through entities, they're avoiding all their taxes. And I help people promote or start or create S corporations because that's the way small businesses should be run, because it limits your tax burden. What happens is a lot of people will start an S corporation, do not really understand how it works and what the tax implications are, and then just go about not paying their taxes, what we call the payroll taxes. And this is a problem. Let's open up the story. Okay, so the IRS overlooked billions in taxes from S corporation execs. When they talk about billion executives, they're not talking about the big company executives who are making all this money and they get all the golden parachute and that's not who they're talking about. When they're talking about S corporations, they're talking about people who own a company, single member S corporations, the pie companies, the law firms, I shouldn't say that because people think lawyers make a ton of money, and they don't. But any kind of business, roofing, any kind of business that you can think of. Most small business people, if they're a corporation, or sometimes you could be an LLC also and claim an S corporation, they will create an S corporation. Okay, so actually what I'm going to do is I'm going to go back here because and the S corporation is what they call a flow through. What they mean by that is the S corporation doesn't pay any taxes. So when they say, corporations don't pay taxes, they're avoiding taxes. No, they're not avoiding the tax. They are paying the tax, but it flows through to the owner. So corporation, an S corporation, let's call it S corporation. S corporation is let's say it's a plumbing company. And the plumbing company has several plumbers, and they pay the plumbers on payroll. The S corporation plumbing, pays payroll. The proper way to do this is to put the owner on the payroll also. So the owner is paying taxes. He is paying his Social Security tax, his Medicare tax, income tax from a check, like everybody else who is an employee of that company. The other plumbers that work there, they're also getting a check, and they're paying Social Security and Medicare and income tax from their check. It's deducted and paid to the IRS for every pay period. And the owner is just like everybody else. They get paid. They're just an employee of the company. Because remember, companies, this S Corporation Plumbing, is a separate entity than the owner. It's not the owner. The owner owns it, but it's a separate entity. So the owner should be a employee of that company. What a lot of people do wrong is that they begin an S corporation or an S LLC, a designated subchapter S, because that's what we're talking about here. It's a subchapter S of the IRS code that allows for this flow through of taxes. And again, LLCs could also designate themselves an S, subchapter S company. And so what a lot of these companies do wrong, when somebody will start an S corporation and then think, I don't have to pay payroll taxes. But in reality, what happens is, if you're not on the payroll and you take distributions from the corporation, then you must pay self-employment tax. And the self-employment tax is roughly equal to the Medicare and Social Security taxes paid to employees. So what an employee pays these Social Security and Medicare tax and splits the cost with the owner. So the employee pays 7.5% roughly, and the owner pays 7.5% on their behalf. So now that's 15%. So when owners do not pay themselves as an employee, they are supposed to take a self-employment tax. And that's, again, roughly 15% of whatever your income was. You pay income tax on your income, and then you pay self-employment tax on that income. But what a lot of people do wrong is they just don't pay the self-employment tax, and they take this distribution. And so that's what this is. I wanted to kind of paint the picture here about what's going on with the complaint that the IRS has. So if we go back to the story, the IRS overlooked billions in taxes from S Corp execs. And again, they're not executives. They're the owners of the company. Generally not executives. They, could be the guy out there plumbing in S Corp Plumbing. He's out there doing plumbing. So he's not an executive in the sense that the picture they're trying to paint here, right? So let's review the story. The Internal Revenue Service has stepped up efforts to collect employment taxes from S corporation officers, but business owners are still getting away with avoiding billions of dollars in taxes. They're stealing. They're evil. They're the cause of our problem. No, they're not. But that's what they want you to believe. A new report released Tuesday by the Treasury Inspector, Inspector General for Tax Administration, and they're going to see this acronym in there in this story, found the IRS is selecting less than 1% of all S corporations for examination for compliance with payment of employment taxes. So and I've had a lot of clients come to see me, and I ask them, "Are you a corporation?" Well, yes. Are you paying self-employment tax? Well, no. Are you paying yourself as an employee? Well, no, I'm not. Okay, so they're not paying any taxes. One of the problems with this is when it's time for you to retire and you're trying to get Social Security, you're not going to have Social Security because you're not paying into it. Well, again, if I didn't have to pay Social Security and I took that money and put it in an IRA, I'd probably be much better off. But that's not what the law allows. Okay, so they have audited less than 1% of these companies. Even when there's so here's the thing. Nearly half of IRS revenue agents don't evaluate compensation. Even when they do examine it, nearly half of IRS revenue agents don't evaluate compensation during the examination. Even though there's a sole proprietor who didn't report officers' compensation and may have taken tax-free distributions in lieu of compensation. And that's just what I was talking about. So you're not paying yourself as a employee, and so you're taking distributions from the company, and you look at, well, it's my company and the profit's mine. That's true. But because you're not an employee, you are subject to self-employment tax. The report comes less than a week after investigative sites like ProPublica. Now, ProPublica is the company that released all of those tax returns from the billionaires and millionaires, and in my opinion, misrepresented what that meant, because there was no allegation that these billionaires and millionaires didn't pay their taxes as the law requires. They just looked at the taxes they paid, compared it to their wealth asset value, which is not how we tax in America. And that's what we were just talking about capital gains tax, and saying, hey, see how evil this is? So now they came out with an investigative site that reported how business owners were leveraging a tax break stemming from the Tax Cut and Jobs Act of 2017 that enables them to save millions of dollars in taxes by being paid in profits rather than salaries. That's not what the Tax Cuts and Jobs Act allowed. It didn't allow them not to be paid as employees. So that's a mischaracterization of that law. That law did not say that you don't have to pay taxes. Tax advisors have been promoting a strategy that encourages business owners to reduce their own salaries while increasing their own company's profits, which they can then use. Well, it's true. Now, you're supposed to pay yourself a reasonable fee. So if I'm a plumber, then I should pay myself a reasonable fee as a plumber. So if plumbers generally make, and I'm just guessing, and again, it's just an example, so I don't want to hear from plumbers who tell me I'm wrong. Let's say a plumber is making $100,000 a year. Well, then I should pay, as an employee, I should pay myself $100,000 a year. Anything over that would be a distribution from the company, and I wouldn't pay taxes on that. And so that's what they're talking about here. Tax advisors, okay, the strategy leverages the lower tax rates under the TCJA, where profits are taxed at a top rate of 29%, as opposed to salaries being taxed at 37%. So this was the reduction of profits was the payback when they gave all of the C corporations, the big companies, these tax breaks. People who are S corporations say, wait a minute, why don't we get these tax breaks? Why do we have to pay income taxes when these companies, other companies, do not? And that was the negotiated back and forth between politicians, that they reduced the profit, the taxes paid on the profit of the company rather than on wages and income. So which was 37% plus additional Medicare taxes. That the AG report focuses more on employment taxes, also known as FICA, that's Social Security, for the Federal Insurance Contributions Act. Okay, so Business owners have been leveraging this strategy for a number of years, predating the passage of that act. The issue of S corporations not paying salaries to officers and avoiding employment tax has been reported for many years, said the report. IRS revenue agents have the opportunity to assess the issue when examining Forms 1120S. That's a corporation's tax return. An S corporation's tax return is an 1120S. U.S. income tax return for an S corporation in the field, addressing the issue more directly by examining it in the IRS's employment tax function or through compliance initiative projects. Okay, so again, they're just saying, hey, people are not paying themselves as employees as they're required, and they're just taking the profit and paying, if they report it, they're not even paying income tax on it. For its report, the IG analyzed the S corporation returns received by the IRS between 2016 and 2018, looking for returns where the profits exceeded $100,000. There was a single shareholder and no officer's compensation was claimed. So this is what I was talking about. Now, the proper way to do this is as an officer, take a paycheck, right? I'm an employee of the company, and then any profits would be less than the $100,000. So, and no officer's compensation. So over $100,000, there was only one owner, and then they got that. So they took the $100,000 as income, as profit, actually, not income. Okay, and they didn't pay themselves like they're supposed to. The analysis found that single shareholder owners made profits of $108 billion and took $69 billion in the form of distribution without reporting they received officers' compensation, for which they would have needed to pay Social Security and Medicare taxes. They estimated 266,095 tax returns may not have reported nearly $25 billion in compensation, allowing business owners to avoid paying approximately $3.3 billion in FICA taxes. Okay, so why I'm bringing this up is when they start posting these stories, what they're telling you is this is what they're going to go after. And they're justifying it. Now, it is true that that's what the law requires. If they haven't been enforcing this rule, and our tax code is so complicated, in most of my instances where I've come across this, it's only because people didn't understand the way it was supposed to be, and that's why they avoided the tax, not because they were trying to avoid taxes or they were trying to cheat the government, but because they didn't understand it. And many times your tax preparer doesn't understand it either. Now remember, the IRS can go back 3 years to audit you. So if they start targeting S corporations and you haven't paid your income, yourself a salary, and you're simply taking distribution at the end of the year of all of that money to avoid and not avoiding self-employment tax, and you're not paying self-employment tax on this, what I'm telling you is you're going to be the target, right? That's why the name today, IRS Targets S Corporations. And if I'm an owner of an S corporation, I'm the target. So not the S corporation, because it's a flow through. They're targeting you. And when they go after the S corporation, again, you, the owner, because what happens is that all that income flows to your personal tax return. And then they will target the S corporation, but they're really going to target you because that's where the profit goes. And that's who pays taxes on that distribution, on your personal tax return. So if you've been doing this for a number of years and you continue to, and then they target you, the money you owe is going to be fairly large. Okay, they're going to audit you. They're going to say you should have been paying self-employment tax on that. So let's use the $100,000 that they use. Here it's actually more than $100,000, but let's use the $100,000. Self-employment tax on that would be $15,000. So if they go back 3 years, that's $45,000. And they say, okay, well, and then plus penalties because you didn't pay all your taxes due, so you're going to failure to pay penalty. And if they hit you with some other penalties, if they say that you fraudulently did this, now there's going to be 75% of that 45,000 in penalties, and then interest going back to the beginning for the 3 years, compounded daily. So that number can get very large very quickly. Okay, so my advice to you, if you're an S corporation, first, I always tell this to S corporation owners anyway, you shouldn't file your own tax returns, okay, because that's a red flag. Because tax returns are very complicated, especially when you get to S corporations or any of this, any company really. So if you're doing a Schedule C deductions or Schedule A deductions, and you're doing it yourself, the IRS is going to target you because these are the people that make mistakes. Again, innocent mistakes, but because tax returns are complicated, it's likely that you're making mistakes. So it's likely that they're going to target you in order to, when they do an audit. And again, they can go back 3 years and then going forward. So what's an S corporation executive to do? Well, first, take action, right? Understand it right now. Get someone that understands how you should be paying taxes. I know most people are not trying to cheat. The last thing you need is the IRS coming after you and auditing you. That's the last thing you need, right? And so most people who are doing this, they're not doing it to be fraudulent. They're doing it because they don't understand. And so if you're running a company and you're an S corporation, and I got to say, a lot of people who are running S corporations don't know that it's an S corporation. So if you're running a company that is a corporation, any corporation, okay, so if you're a C corporation, it should probably be an S corporation, and there's some problems there that should be rectified because sometimes you pay double taxes then. And that's what they're trying to do now, right? They want to go back and say, okay, you should have been a C corporation. Actually, this is the second part of this story. So if I go back to the story, let me go back here for just a minute. I'm not going to spend too much more time on this story, although I think it's important, because then they go back to those that are not citizens, and people who aren't citizens can't really have an S corporation. So if they do have an S corporation, they can go back and here it is. Let me see. Another issue involvement of non-resident aliens of business owners. They can't be S corporations. So the IRS can go back and say, well, you're not an S corporation. You should be designated a C corporation. And the C corporation has to pay taxes, unlike an S corporation. And then the IRS can say, so this was really a C corporation, and any money you made should have been taxed. And then it goes to you, and then you should be taxed. So then it would be double taxed. And that could be a hefty amount of money, right? That could be big. So I don't know how long we're into this. Let me see how long we're into this already. Okay, we're already too long. I had another story. I'll save it for another day. But I thought it was important to take the time and talk about this the way it's supposed to be in S Corp. You are now the target. Okay, so if you're running an S corporation, get somebody for tax preparation that understands this. If you're going to owe some money, that's us. We understand S corporations. We can help you, try to avoid getting audited first, and then if you get audited, what to do next. Okay, so that's what we'll be happy to help you with. But I thought it was important that we talk about it, and so that's what we did. And I spent a lot of time on it. Now remember, if you're having tax problems, get a copy of my book. Deal with your IRS problem today at freeirsbook.com. Again, freeirsbook.com. Get a copy of my book. If you know someone who runs a company, if you know someone who may benefit from this advice, share it with them. Like, subscribe, share. If you subscribe, write in the comments that you subscribe. So like, subscribe, share. I think I had the music on underneath, so I apologize for that. But like, subscribe, share. I appreciate your time here today. Again, our production staff that should be brought up on charges. I appreciate I appreciate you today. Again, thank you so much for watching, and we look forward to doing this again tomorrow. Now, remember, tomorrow's Crypto Tuesday, so we're going to talk about cryptocurrency and the tax implications for cryptocurrency. So again, join us tomorrow. Thanks so much for joining us. Uh-oh.